Let's run through the performance of the listed property sector for this year in terms of returns relative to that of the JSE All-Share Index.
Well, property has been the best performing asset class, giving you almost 30% this year. But that's been because bonds have been so strong, which has benefited property compared to the other equity classes that were more detrimentally affected, I think, by the general environment.
Emphasizing the possible defensive characteristics of this asset class specifically that may well be overlooked. So let's take a look at drivers and what's boosted this asset class higher in terms of returns.
What boosted the asset class most was the bond yields coming down, which directly impacts property prices. Yields come down, prices go up. And all of the return you got from property this year was solely due to the fact that bond yields came down. It wasn't property, it was bonds. However, having said that, the defensiveness is that even in weak environments, property distributions, the actual earnings, have been pretty steady. There's been no collapse in earnings. So you've had the rise in the capital values because bond yields have come down, and you've had stable earnings growth. And together that has resulted in a good year's performance.
Well, looking at that kind of correlation that the property sector has with the bond market, we're looking at a correlation of roughly 83% at this stage. So a lot will be dependent on the direction of bond yields moving forward. What are your forecasts in that regard?
Well, that is a key risk for property next year, of course. If bond yields reverse, then those gains that were gotten because the bond yields reverse. But at the moment, the interest rate outlook looks quite benign. So, I mean, bond yields certainly will go up in the future. But in what we can see at the moment, things look pretty stable.
Yet I've come across various reports forecasting a less than stellar performance heading into 2011. What are your expectations and factors being taken into consideration for the performance of this sector next year?
I would agree. I would also expect less than stellar returns, but still pretty decent returns from property. You've still got distributions growing. You've still got a yield of about 8% forward yield with some distribution growth. So the outlook isn't bad at all, but we're not going to see we're highly unlikely to see the drop in bond yields which enhanced performance that we saw last year. So we're not going to have any added benefit from that. But on its own, if bonds behave, I think investors can have decent double-digit returns, low double-digit returns from property, which isn't bad in this environment. Remember, all returns are very low in this environment, and inflation is low as well. So in real terms, it's not a bad return.
To what extent do we need to start making distinctions between various kinds of property segments within the listed property space? I mean, we've got commercial property, for example, still being weighed down by the office sector in particular. Current vacancies there averaging 10%.
Yes, I mean, the retail sector and the biggest exposure of listed property is to retail is in much better shape than offices. Offices are the sector that worries me the most with those vacancy levels. Most of the listed property sector, unfortunately, is quite diversified, so it's difficult to get pure plays. Though in the retail, in terms of retail property, you do get some pure plays, and with some of the corporate actions and new listings, those pure plays will be increasing next year.
Let's take a look at some corporate activity within South Africa's listed property market, because that seems to be picking up. We've had two big ones hit of late. Capital Property Fund looking set to gain full control of Pangbourne properties, and that being seen as a consolidation of interest. What have you made of that move?
That's been expected. I think the timing wasn't that it would be so soon, took us by surprise. But it's all managed by the same group. So it's just this group consolidating those funds as expected. But the potential Hyprop at-fund deal wasn't expected until a few months ago, and that's going to result in a far larger fund. I think the theme is potentially three mega funds, you can say, entering the listed property space, 2 from consolidations, 1 that could be a new listing. So we could have 5 funds next year with market caps larger than 10 billion, compared to the current situation. We've just got 2 property funds with market caps larger than 2 billion.
At this stage,
which will add to liquidity.
Now let's take a look at Hyprop specifically. I mean, what value in your books does a player like Hyprop offer at this stage?
Look, the yield is low because the quality is high, so we don't see it being ridiculously priced. However, details of the proposed transaction with Act Fund haven't been released in terms of the actual numbers. So it's very difficult to evaluate the transaction before you've actually been able to crunch the numbers and see exactly what the price is and the detail of that.